Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Welcome to the Australian Property Podcast. I'm Chris Bates. We're on the mission to become Australia's most trusted property podcast, and got a special guest in today. We're going to do an episode on tax and mistakes you can make, opportunities. So it's going to be a really interesting episode. We've got George Morice, from Prime Partners in Sydney. And we're just going to have a really good chat. There's lots to know on the tax and things you can avoid. There's a lot of myths out there, I find. And so, George, let's just start at the top, and thanks for joining us. We're sort of first home buyers in capital gains tax and investing. What sort of, I guess, some of the things first home buyers should be thinking around their property moves and tax?
Yeah, morning, Chris. Thanks for having me on. Look, capital gains tax is first home buyers. They're not going to be exempt, obviously. They're buying in now. So the first thing to think about, really simple, is if you hold a property for a year, that your end tax goes down by 50%. There is a discount if you hold it for more than a year. So look, with property, it's the same for shares, but with property, very rarely will you ever sell it within a year. But just a thing to think about if you're looking to transact quite quickly, holding it for over a year is really, really important.
That's an interesting one because it's unlikely. CoreLogic have come out this week and said there's been a lot of property selling with under 3 years, and that does make sense a little bit. That 2020, 2021, the boom, maybe they're taking money off the table, or they're really stretched financially and they're having to get out. And if they are some investors, if they're losing money, I guess it doesn't matter. But if there is some gain, sometimes, is that on the settlement date? Just out of curiosity,
contract date.
Contract date. So the contract date that you buy and then the contract date that you sell. Is that right? Yeah, cool. So that's if the first home buyers, buy an investment property, beware that if you do buy an investment, try to sell it after 12 months. But in terms of things like avoiding and rent vesting, have you thought about, do you get many clients wanting to potentially live in a property and then move out of it for something called the 6-year rule? Could you explain that to
the 6-year rule. Really interesting thing about that, and you're talking about myths before. Everybody quotes got to live in there for 6 months or got to live in there for 12 months. The legislation says nothing about time period. It says about intention. Okay. Now, look, the ATO general guidance, you want to have shown intention to live there. And if you move in for a day and move out, you're not really showing intention. But if you have lived in a property and you decide to rent it, from that date after moving forward, the next 6 years, even though you're renting it and you're able to claim the income and expenses in your personal tax return, then you cannot pay capital gains tax for that period. Now, once you go over that period, anything moving forward after that, yes, there's capital gains tax period. But if you move back in for a year or so quite often people might have gone overseas or something, you move back to Australia, you live in it for a year, that re-triggers the 6 years. And that's a lot of people miss out on that one. They go, I can do it for 6 years, but actually you can do it on a rolling basis. You can move back in, move back out, and it refreshes that 6 years.
Yeah, so I guess the key thing, sometimes first home buyers, they go, oh, well, I might just rent it out for a little bit first. I'll keep living with my parents. I'll keep renting my flat share, and then I'll move into it in a year or two when I can afford the mortgage a bit more. But that makes them ineligible for this 6-year rule, doesn't it? It does.
And if the property price goes up significantly in that period before they move in, then it's going to have a negative effect long-term when they do sell it. Interesting thing that people sort of don't assess very often, I've done up some financial models on it, is are you actually best to move in or not? There is a starting of a wave of people who move in, yes, at the start, move out and rent, with the intention of renting and actually holding this property as an investment. And from a cash flow point of view and a long-term wealth point of view, they're actually better renting than living in the house they own. Now, that's not every scenario, but quite often, especially with interest rates going up now, the ability to be able to make that interest rate deductible, claim negative gearing, makes a huge impact on the long-term wealth.
It's really good. It's a really good point, right? So you think about someone with a bigger mortgage, right, that maybe has a bit of flexibility with renting. There's, maybe they're a couple or even with families, they might say, well, we don't need this big house right now because we've got, young kids. We're happy to rent something a bit cheaper, like an apartment. Our mortgage is crippling us a bit. Maybe we're better off to move into a cheaper rental accommodation. That will reduce our costs dramatically, and then that makes our mortgage tax deductible for potentially up to 6 years. And
and all the expenses of that house. So when you actually do out a model and look at it, quite often the tax savings are huge by doing that, and your overall wealth. You're still getting the capital gain on that property. You're still generating long-term wealth for yourself, but maybe you're just not living in it now.
Yeah, and I think under low interest rates, that costs to benefits, 2 or 3% interest rates, maybe it's just as cheap to live in your property, right?
Yeah.
But when rates are getting into 6s and and above, or even the 5s and above, right? That you can do the numbers on this, and the modelling, what George is sort of suggesting here, makes good sense. And we've suggested this to clients who are struggling a little bit with their mortgage. Could they, take it on the chin a little bit? Maybe I don't need this house right now. Maybe I'm happy to move out and rent it, but instead of selling, maybe we can just stay in the market, not have to avoid paying stamp duty and selling costs in the future, and the market running on us. And the other thing you find really interesting in there is the same discussion happens when they're looking to buy an additional house. So I've done sort of models with people before where they go, can we afford this house? I think I'm going to have to sell. So quite often I've got a unit. I want to buy a house. The only way we can afford it is actually to sell the unit. And the end result is actually, if you keep the unit, buy the house but don't live in it now, is more affordable than selling the unit and buying the house. That's an interesting. So, because they could potentially use, assuming they could borrow the money, I guess that's a bit of a challenge in this market, because borrowing is only maybe 4.5 times your income, versus 7 times your income. So it's harder to buy assets and keep assets. But
the other side of that, Chris, sorry to cut you off, is you're getting 2 lots of income because you're renting both properties.
Oh, I see what you're saying. So you're not just living in the apartment, then you go and rent a house that suits you right now that's a bit cheaper. Yeah.
Which is a very unusual thing. I don't think many people really think about it in that way. But, I'm a huge numbers nerd, right? So I do the numbers on it. And suddenly that makes sense. And you can give a sort of a second or a third option. Now, people may still just want to sell the unit and buy the house, but having another option is always really powerful.
Yeah, there was a client just in the last 6 months who wasn't a client of ours, but came to us, who was under a bit of, debt stress, I guess. And, it was down in Geelong Way in Victoria, and they ended up moving out of their house. That's the option. We sort of said, we can't refinance you. We negotiate a better rate. They'd gone to another broker in the past. And and I think you're right. I think people should explore, potentially, renting if it means holding assets, or even just from a short-term play. What about repairs and, if you have renovated the place, is there a bit of a benefit here as well with depreciation or things like that?
So we'll separate out the repairs and the renovation, because quite often that's sort of a tricky point for people. So repairs are your small things you're doing around the house. That's instantly deductible in your tax return. So that'll be offset against any income, rental income, and if you end up in a loss position, which is what people call negative gearing, that can be offset against your other income. Now, renovations, I guess we'll link quickly in. I'm not sure if you've talked before about, getting depreciation reports and things done up.
No. We can talk a little bit about it.
Okay. First thing I ever do when the new client comes on with the property is call a quantity surveyor and see if it's worthwhile, which they'll charge you nothing for an assessment. See if it's worthwhile getting a depreciation report done up. That will then allow you to claim the building itself plus the assets in there, a percentage of them every year, as a deduction. And it's this sort of Goldilocks deduction because you don't pay cash for it. You get a deduction in your tax return like if you'd paid cash, but you don't. It's just actually depreciation value of that building and those assets. So incredibly powerful tool to help reduce your tax, which obviously gives you more free cash flow. So a renovation is something that could be done in that way.
Yeah, it's interesting. I remember a client, she had quite a lot of properties and she never had a depreciation report. And I see it quite a bit all the time. Maybe cost you $500-600, right? Not much. And, every property, it means appreciation benefits have been watered down a little bit from my understanding over the years.
It has.
But you still doesn't need much to be able to claim to get your $600 back.
No, and that $600 is also tax deductible.
Yeah.
So for those playing along at home, the $600 is roughly what it'll cost you to get the report done.
Yeah, exactly. So I think that's an interesting conversation. And the 6-year rule, we've got a client at the moment. This is not going to be relevant for all our listeners, but they have lived in at the start, but they've moved out, and a lot of people believe that if they didn't move back in within the 6 year, then it's not deductible for the whole time. That's not true, right? Like if you moved out of it, in 2015, or you bought it in 2015, you lived there for 3 or 4 years, and then you moved out of it after 6 years. Like, how did the ATO figure out where the gain starts? Is it just literally what it would have been worth when you moved out, and they do a bit of a rough calc what it was worth back then?
I won't go too technical on this because there's multiple answers.
Right.
Because depending on whether you lived in it first, whether you rented out, lived in it, then rented it out, there's actually different methods to calculating it out.
Yeah.
But
Okay.
the overarching theory on it is that 6 years is exempt.
Yeah.
We have different ways of calculating exactly how that is exempt based on a history, but that 6 years is exempt. You can live out for another 15 years. That 6 years is exempt, and it can be an apportionment or a getting a valuer in depending on the method.
Yeah. Okay, cool. So you can do it based on a evaluation sort of rough measure on what it would have been worth when you moved out rather than
if you just moved in first,
if you moved in
before
first.
ever renting it, then yes, that's the method you use.
Yeah.
You get a valuation at the date you moved out. And that resets the cost base at that point.
Yeah, and I think it's sometimes people, they say, well, I lived in it for 3 years and I rented it out for 6 years, and so I don't know, I should pay tax on 2/3 of it or something, right? They don't look at it, and then for what matters is the growth of that was actually happening over the time frame, right? And so potentially when you moved out, actually it was a higher value than what it's worth today, and so you don't pay much capital gains tax. And so it's an interesting one for people to think through. But the 6 years rule is definitely something we've seen a lot of first home buyers use, and you made some really valid points with homeowners who may want to use it just from a cash flow benefit. And obviously there's other reasons that people are moving into state and things like that. What are some other sort of tax mistakes you sort of see made? I mean, people bring up some amazing, structures in property to help people to build portfolios out and things like that. What's your sort of take on whether you should be buying personal names or trusts or company structures?
I'll probably offend people here a little bit, but generally speaking, people overcomplicate it for their own gain.
Yeah.
Like I have clients come in with complex structures and I have to unwind them because it's actually not giving them any benefit and it's just making me richer, right? And there's people pushing these sort of products. Now, there is certain scenarios where I'll bring a structure in, but keep it simple. At first, keep it simple. The key things you've got to think about are actually risk. So if there is a key person involved that is at risk, so a doctor, someone who runs their own business, those sorts of things, potentially that property shouldn't be in their name. So that might be in a spouse's name, or then, depending on the state, potentially a trust, and I won't get into why a state, New South Wales is not great. So there's that. That's a key thing when you're looking at those sort of structure things. But company trust things, there is downsides. And until you have more property, they quite often are not relevant. And the other one, I guess, a lot of people do is self-managed super funds.
Yeah, so I think the takeaway here is that for most people, unless there's a real key risk maybe with your business or you're going to get sued, I guess, potentially throwing a property in a trust or property in a company might be great for the accountant in terms of charging more fees, but do you really get value out of that complexity? Because the downsides can be things like, writing off losses might not be possible. There could be, potentially no capital gains tax exemptions, company tax rates, and those sort of things. Those can dwarf the benefits of
100%. Yeah. You can have massive problems with it, and it's in people's interest to spruce these things up, make them look a little bit better than they are. Whereas simplicity can win. There's so many other things you can do that are probably more beneficial, especially on your first or second property. Once you get to 3 and 4 and things, then structures do start to become relevant because all the benefits you get by holding them individually start to dissipate away. So you may as well get the flexibility of some of these other options.
Awesome. So Airbnb is a hot topic. Dan Andrews came out this week and threw before he left, threw a 7.5% tax on Airbnb owners. A parting gift, you might call it. But I mean, we've seen this a little bit as well. Some people are, they've got a house, but they want to go to Europe and they want to just Airbnb their house for 4 or 5 weeks. And then they do it every school holidays, etc. And they're Airbnb their home. And, can you explain some of the challenges from a tax point of view that could create that they might not be aware of?
Yeah. So obviously there's an administration part just to start off with, actually figuring out what percentage is claimable. You get taxed on the income, so you've got to figure out all the expenses. Are you renting out part of your home? Are you renting out the full part of your home? It's going to be different. To get in the really technical side, there's actually a question. The first question you ask is this house pre-capital gains tax? Because if it is, even though you're renting it out, doing income producing things, no capital gains tax implications.
So that's if 1986, isn't it? From
that is. So we've got 2 key dates here. That's 1986. Then we have, that was 20th September 1986. And then there's another one, which is 20th of August 96.
Right.
Which is another one because basically if you started renting your home out at all before that, there's a different rule. Now, because most of the people listening are probably not in that situation, I'll leave that one out. But the main thing we're talking about here is the capital gains tax implication of renting your place out. Now, post that 96 date, if you went and, got a rental property, got that Airbnb'd out, you potentially are going to have a capital gains tax implication on your main residence. Okay, which you've really got to weigh up, and a lot of people don't before they Airbnb it out. You go, okay, well, if I do this for a period, what's that going to look like? And it becomes like with the situation you're talking about, it becomes a days calculation. So I've held the property for 1,478 days, and of that, 48 days of it were rented out. Then I actually have to adjust my capital gains tax by that. So if you're just doing it once a year, probably not a big deal. It's not going to have a huge implication, especially if you've got a really nice home that can get you a good amount over the Christmas period or whenever it is. If you're doing it more regularly, then you've got to ask yourself, am I doing it the whole house or am I doing it a portion of the house? So there's actually 2 different ways that's taxed as well.
Yeah, and I think that a lot of people just go, I'll just throw it on Airbnb, I'll just rent out my granny flat or my studio, and that's the same sort of challenge, right? It's income on an asset that's growing tax-free for you, and not years down the line they sell their home and they go, I thought it was tax-free, but we've actually got this capital gains tax bill on our home, which when you look at the tax costs there, the problem with, I think, with Airbnb income, people don't think it's taxable, right? Even they bank it, they spend it on their holidays, and then they got to give, they don't get as much back in their tax refund because they had to pay tax on their Airbnb income. So there is potentially some people who have better potentially getting some money in your pocket if you need it to cover your mortgages and versus selling the property. But just be aware that if you do it on an often basis, you could be up for this liabilities, particularly if your home's growing strongly tax-free.
And with all the expenses that come out and how much cash you actually end up with. And then you've got to look at, us boring tax nerds, right? We need to get this right for you. So if you've rented out a part of your home, we have to say, okay, well, there is the things that are developed like directly for that part of the home, some furniture, those sorts of things. Then you got to go and figure out, if you've got professional photography for the listing, that's deductible against it. Then you've got to look at repairs and maintenance. Is it for that part of the house? Is it not? Power bills. Okay, now we need to figure out floor space and apportion power bills based on the percentage of the house, then the percentage of time that you used it. It can just get costly, It's really good if you need a little bit of cash. But generally speaking, looking at it on a long-term basis, there's not a heap of value of just doing little bits of renting out your home.
Yeah, it's an interesting one. I think we are seeing that more and more often where people, they can make some decent money on Airbnb. And, but then you really got to weigh up the after-tax benefit. How much is it really? The whole hassle to get that's
the effort.
And then the organising your tax. And then is that all going to then be wiped out by, if your house grows strongly over that year, you could lose that in a capital gains tax liability in the future.
Yeah.
And so really think it through. It's not as easy as it sounds to have your cake and eat it. I mean, a lot of people don't really understand the deductibility of loans. A lot of people think, I can't, I've got a loan against my house and I bought some shares with it. That's not deductible because it's secured by my house. Or, I can just move my debt from my home to my investment property, and that means it'll be deductible. And can you sort of explain where, I guess the thought process between what makes a loan deductible or not, and and some of the mistakes, because people do get into these problems with debt washing and joining all their debts together, and it becomes a real nightmare down the line.
Yeah. So the first thing sort of around that is how you figure out whether it's deductible or not. And that's what the money was used for, not what it's secured against. So your example there of buying a share portfolio, you bought a house, you paid down some debt, you had some equity, you redrew it. That redrawn portion, so let's just make up some figures. You had a $500,000 debt, you took $100,000 out. Or you got it down to $400,000. You took $100,000 out, you're back up to $500,000. Now, 20% of it has been taken out to buy shares. 20% of your interest is now tax deductible. So that's the first thing, the intent. Now, where tax accountants become really helpful here is how to ensure that you get the majority of your debt that is humanly possible as tax deductible. So if you are going to be having an offset account, then my recommendation is always just put the money to the offset account, never to the loan, because that gives you options at a decision point. Okay, so what can happen, and I'll just run through two scenarios. You've been building up your offset account, you've got some money, and you want to go buy a new house to live in. You go, I'm upgrading. Now, you take that money from the offset account and use it to buy the new home. The original loan is still high. So now you're going to rent out the original home and it's got more interest. Okay. So you can see there where by not putting it in and redrawing it, you've got a benefit. Okay. Then, so making sure you get your timing right on that and giving options is what's really, really important around offset accounts. So my piece of advice to clients is always only make your minimum loan repayments, and then before making any decision, give us a call and we'll find out the way to make as much of your loans as possible tax deductible.
Yeah, it's a really big point, this. So a lot of first-time buyers make this mistake. They do the right thing. They buy a property. Yeah. They get a loan. Maybe they borrow at 80%, or maybe they pay lender's mortgage insurance, which I'll ask you a question on in a second. But and then they do the right thing. They bad debt. Debt is bad. They get their parents in their ear and they just knuckle down and they smash that mortgage down. And they buy a good asset and that goes up in value. So they build heaps of equity in their first apartment. But you're right, they didn't use the offset account. They just reduced the loan balance. And, then they come to us 3-5 years later. Oh, you know what? We've had a couple of kids. We need to upgrade from this apartment into a house. But it's a really good investment. It's done really well for them. Yeah, it's growing tax-free, but they really want to keep it. But there's just no real advantage to keep it because they've paid off that loan so much that if they do upgrade, they're going to have a huge debt on their new home that's non-deductible. And, from a tax cash flow point of view, when you do the numbers, it really just makes sense to sell the apartment. Whereas if you listen to what George was saying there, if they just did the same thing, but instead of paying down the loan, just put money in the offset account, they would have kept that debt high and then had the chance of keeping that apartment as an investment property. And it's a big mistake I see people make.
That's one of the key ones. And there's one other, Chris, that I see quite often is, and it's going to be so relevant now with rising interest rates. They wait to their tax return to get a refund when they're negatively geared. So the time value of money is super important. You're paying these interest rates at 6%. You can, if you're going to get a tax return, you're going to get a tax return because of negative gearing. You can change your weekly, monthly, quarterly, however often you get paid, you can change the amount of tax that's withheld at that point. So you're getting that refund instead of, 3 months after the tax year's ended, as you go.
And my belief, George, that's quite easy, isn't it? Well, how do people do that?
So it's a pay-as-you-go withholding variation form. it can be a little painful. The actual form itself, we do it for a bunch of people because it is painful. But basically, that gets lodged with the ATO. The ATO then contacts your employer and says, "Hey, you're meant to withhold at this rate based on this, but because of what we know, you can withhold less." That might mean $50, $100, $200 more in your paycheck, and that just goes directly against your offset account if you don't need the money, and then that is reducing your interest, which, we all know the compounding effects of that over the 20 years of the loan is huge.
It's a good point. Yeah. So someone has got a decent negative cost, a big deduction with an investment property or something like that. I mean, if it's positive cash flow, this won't help you, right? But if it's a negative cash flow property, and particularly what George is saying, under higher interest rate, which a lot of people are feeling right now, get this variation done instead of getting this big tax deduction in July or August or September, whenever you lodge your tax return. Get it throughout the year. Get that money in your offset account. Save that interest, which is a lot of money, right? Under 6-7% interest rates.
That's huge.
And so it's a double win. You say you're getting that money today, but you're also offsetting your debt rather than just sitting on the ATO's balance sheet and making them some money. So that's some really good advice.
And it's the really boring accountant thing of looking over 20 years of the impact that has. The compounding effect of not having to pay that interest, and they're not paying interest on the interest, it is huge.
George, what's some deductions you think that people, they come to you and you sort of do a bit of an audit on their tax return and said, "Oh, no, the accountant missed that one." Or actually they did their own tax, they missed that one. I mean, borrowing expenses is something that easily can be forgotten about. They paid lenders mortgage insurance.
LMI.
And that's deductible over 5 years. Is that correct? Like, if it was an investment property, if it was not a home. What are some other things that you sort of see people?
We've touched on the depreciation and quantity surveys report. That's probably the most common one. The apportionment of the interest we talked about is quite often another one. The lender's mortgage insurance, and then the out of pockets. Like, people quite often get so busy in their life, they have an agent looking after this, and they get the agent statement and they send it and go, "This is what it cost me." And you go, "Are you sure you didn't have this, or this? Was there anything else?" And just general landlord insurance. Quite often that's paid personally by the owner rather than the managing agent. So, we'll quite often go back and they're like, "Oh yeah, I think I did pay that." They'll find it. That's an extra $1,000 or $1,500 deduction. So it's quite often the personally paid things when you have an agent managing the property.
Yeah, things like land tax, right?
Land tax. Now, hopefully, if it's your first property, we can avoid land tax.
And
I actually find that one stings enough that people remember it.
Yeah, exactly. But it's good. You can get tax deduction on paying tax. That's always a nice thing. I think there's some really good points there about just keeping really good records. I mean, I actually, even if it's something I've had to arrange for a property, I'll just say to the agency just to pay it for me, just so it goes on their records and so you don't forget about it. But, if not, or have separate bank accounts that you only pay things for the properties, offset accounts linked to your properties. I think keep it really clean, then you don't forget things rather than paying on your personal credit card, and it all gets too messy.
You go chasing the points.
Exactly. And then you've missed out on all these tax deductions. So.
You had an emergency plumber come out one night. You did it at 11 p.m. You threw it on the credit card. It's 12 months later. You're doing your tax return. You just don't remember it.
You don't remember it. That's right. So I mean, I guess some really good points there around the borrowing costs. I mean, buyer's agents is another purchase cost. What's your take? I've different accounts said different things this in the past. I mean, if they use a buyer's agent to purchase an investment property, what's your thoughts around the deductibility of their costs?
It can be clever, this is the only way to describe it. You've got to make sure that the purpose based on the invoice was correct to make it as deductible. So we talk to people about that before that process happens. But on a higher level around buyer's agency, just a personal observation is worth their weight in gold.
Okay.
From watching what my clients have done, the way they've transacted, the deals they've got, the support and negotiation, I've found it to be really, really powerful. Really powerful.
I think that's good, George, because what that does is that's a good independent voice. They're backing buyer's agents, right?
Yeah.
So George isn't a buyer's agent, right? So you're not just pumping the tires at buyer's agents.
No.
We get the same experience. So we work a lot with lots of different buyer's agents all over the country. And even today, I've got to talk to a client about using a buyer's agent, the value proposition. And we see it because we see lots of transactions, but a lot of first home buyers or upgraders, it's a service that's very intangible. It's very hard to know what the value is, and people are very skeptical. It is a very high cost service as well. But I guess picking the right buyer's agent is the hard part here, George. Right?
It is. It's like anything. There's a lot of people out there that aren't doing a great job, but finding the good ones are worth it. And the investment property, complete no-brainer. Then you go buying your own home. People go, oh, I want to do all this research myself because I know what I like. I know what I want, which is true. Like there's definitely that element. You will be much, much more involved than the buyer's agent is if it's your own home. But don't forget, like if you're talking about a significant investment, the negotiation alone pays the fee. Like the skill and experience of dealing with real estate agents and helping the negotiation side pays for its own fee. So from that point alone, and then you actually get the extra support of everything else a buyer's agent does on top. Yeah,
absolutely. It's a very emotional time buying properties, and you might think you're a great negotiator, but you're not compared to a real estate agent that does it.
That's
hundreds
their
of
job.
Transactions a year. You can very quickly. I'm not great at it, to be honest. And the buyer's agents just tell me to shut up because I talk too much. So it's a really good point there around buyer's agency. I mean, around sort of tax and things to sort of be concerned around. With superannuation, I mean there's a lot of people that come and want to leverage super into residential property. I mean, commercial is a different kettle of fish. I mean, what's your take on using SMSF and going into limited recourse borrowing arrangements and leveraging people's super? Like, what's your experience and what you've seen people do and how it's performed?
Well, the Australian property juggernaut keeps rolling on, right? The only time it's going to go south is if the property stops rolling the way it does. Because the big consideration there, well, not the big, one of the big considerations is your interest rate's going to be higher borrowing with an SMSF than it is if you borrow in your personal name. Now, there are some strategies you can use to borrow in your personal name, lend that to the super fund and receive interest, but you need to have certain equity and different situations going on to make that work. So that's one way of managing interest rate. I've seen some people be really, really successful. We have a self-managed super fund department. I've seen some people be really, really successful with it. One thing I think, Australia is property mad. And this is a property podcast, so I shouldn't say it, but you've got to make sure you've got balance in your life. You know? And if you're very, very heavily balanced towards property in your personal life, do you also want to move that super into property as well? Now, your answer can be yes. I have plenty of clients that do, right? And that's a personal decision. But it's a consideration you should have. Have I seen it be successful for people? Yes, I've seen it be very successful for people being able to gear their super to get, a significant return there.
Yeah, so I think it's a really good point, right? People are very leveraged in their home, investment properties. They might have a business and commercial property, etc., and they've got nothing. The only thing they've got outside of property is their super fund, and then they go and put that in property as well. And the diversification in their life is almost zero.
And if you believe in property, there's no issue with that.
Yeah. Do you find it's usually the bigger balances and people, leveraging it on a higher end that have done well, rather than people with smaller balance in self-managed super funds and buying resi properties? So, the type of properties they have to buy and the risks and things like that. You've seen some people have blown their supers up and things like that?
I've never seen anybody blow it up because the property prices have just been going up nicely.
Yeah.
And I'd actually say it's the opposite. I see it's mostly the lower balances. The high net worths, we have a bunch of high net worths, are diversified. So they don't necessarily need their property in the super funds. With the high net worths also, what I see is quite often they're running a business and they will have their business premises in the self-managed super fund. So that could be a barrister, a farmer, an accountant. I don't, but an accountant could have this office in the self-managed super fund and be paying themselves rent, getting the tax benefits of paying the rent in the business at the business tax rate and only paying 15% tax in the self-managed super fund. Look, I do find that people look forward, and the reason I think they really like property in self-managed super funds is they look forward and go, okay, well, if I can gear it, I should get this greater return. compared to, an ungeared investment in, Australian Super or someone.
Yeah.
So for them, it is genuinely about trying to maximize what they have at retirement.
Mm. Yeah, so I think it sounds like you haven't seen too much of the poor property decisions. CoreLogic sort of released a quarterly, I think it is, gain and gain report, and that really shows the tale of two investors. The 40, 50, 60% of investors that maybe buy apartments or buy in Darwin or Perth or and have had some really bad outcomes. And then you've got the other ones that have maybe bought houses in good areas and have done really well. And my advice would be, if you are looking to leverage your super, just you really need to understand what's a good asset, because you are punting your super. And we've absolutely seen, there's a lot of firms out there that push people down the off the plan sector, things like that. And, that's stitching up their super funds, I guess. So,
and maybe it's also our clients are maybe a little bit more thoughtful. And they don't go in with super low balances. Like we don't give super advice. We just do the compliance part, but we are always very uncomfortable if someone comes with a very low balance and it's like, I'm buying a house. Yeah.
George, you've seen you've got a lot of people from the small businesses, $100 million plus businesses, right? And probably even things on the ASX. You've probably and you've got families that are, at all different elements of wealth. The bigger ones that have, what do you think they've done really well from a tax point of view that have really catapulted their wealth compounding over many generations?
Yeah, I mean, compounding's the key word, right? Compounding's right. They quite often have taken some form of risk early. So whether that's starting a business or making investment, and they've done it in a smart way. They haven't just been like, I need to take a risk. Where's a risk? Let me take it. They've looked at something on this seems an abnormal return. But once they've done that, they don't chase the risk again. They then slow their risk profile down. Especially, when you're young, you can take a risk and you can bounce back if it goes wrong. As you get older, you probably don't want to be taking those risks. I once had a client in their 70s take a huge risk and go bankrupt. That's a very tough conversation because, where do you go from there? So they then dial it back. They start to just consolidate, but they've done all the little things along the way. So they're engaged with it. They've thought, we talked before about a pay-as-you-go withholding variation. That's a 20-year benefit. They've looked at that and gone, okay, it is a little bit of a pain. It is going to take me an hour to a year to do, but they can see the long-term impact of it. So it's all about having an idea of and a plan also. So quite often the ones that I've seen successful have had a bit of a plan. They've tried to project things out a little bit further and gone, okay, well, I will sit down with, a professional advisor and go, okay, what's this look like in the future? Rather than just deal with, I want this now. I guess it's a more thoughtful approach.
It makes a lot of sense. I love the, you're right. They've taken their risk early, for example. That's got them ahead and they realize that they've got themselves to a strong position now. So let's not just risk it. We see, you're right. As people get older, their risk profile naturally decreases, right? Their appetite for, so you don't jump off, cliffs when you're, in your 50s, 60s, right? You don't take up extreme sports. So people naturally get more conservative. I do find people do get maybe sometimes too conservative.
100%.
40s, 50. They've almost got it too easy and they don't realize there's a longevity risk or a running out of money risk. And so you've got to be careful about too risk. It does make sense to reduce risk. And then, making the small tweaks per year in compounding, I think that's a key point. Have you seen them do really well out of, their homes and growing tax-free and making really, do you think that's the biggest opportunity? Sometimes people, maybe just buy a house that suits them, but they sort of forget that it's also one of the biggest opportunities because it grows tax-free.
100%. Like a main residence is incredible. It's incredible. Nowhere else really do you get to sit there and make money and not pay tax on it. Super funds maybe a little bit, but it is incredible that you can do this. Now, where the balance lies is getting your positioning that is making you money and not costing you money whilst you hold it. So, the holding costs are sustainable. What I see a lot of people do is they go really heavy on their first home, their forever home. And that's driven by stamp duty legislation and a bunch of things, but they go very hard on it. And it means they've just spent 40 years, 30 years grinding that loan right on the edge of their cash flow. And it's sad to see, because you get 30 years down the track, you're busted, you're exhausted. So trying to not get carried away in that first one, good home, don't get me wrong, as a good percent, but don't go everything. Don't go everything on your home, because that's the same people who interest rates have gone up and are now looking to turn over their homes.
Yeah, it's a really good point. If you are doing it, be really confident on your trajectory of income, your future cash flow, not you're on your peaky earning cycle, or you're going to go into the baby stage, and you haven't got any buffers left over, or you buy a house that needs a lot of work. And I guess
the other thing I'm not sure if you talk about is when you get to that point and go, I have gone in, I am in trouble. What happens if one income drops out?
Yeah.
And do I protect that? Do I get income protection insurance? The conversation I quite have often around babies and marital.
Yeah.
And the two things that are really important to think about outside of it is wills and insurance.
Yeah.
What happens if someone passes away? Really, really important question. So if you've got this big debt, then you probably should have some, TPD insurance, and have that reviewed, not just, I've got some in my super fund. Have it reviewed, because I've seen the super fund ones go really wrong.
George, I love what you're talking about here, because what you're demonstrating, hopefully our listeners are picking up on this, is George being a trusted advisor here, right? George could just think, I'm just going to look after my clients from a tax point of view. But what you're preempting is issues that they may not have considered as important as they really are.
Yeah.
And you're highlighting that they need to go sort them out. George probably want to get paid at it, making sure someone gets their insurance, but he sees it as a risk. And, this is what a true trusted advisor does. They educate on all the elements of someone's life, and then bring in experts when they need it. And so the only final point I want to end on today, George, because something I'm just noticing a lot with our clients, and we're seeing deposits, and not everyone's fortunate, right? But we're seeing deposits come down from intergenerational wealth, particularly in the Sydney market, that are astronomical, to be honest. We're seeing the biggest deposit I've ever seen when it's coming from grandparents to parents to kids. And I don't know if it's about this super change. I don't know what's this, catalyst where people are just willing to give away a lot of part of their wealth down. What are you seeing, George, around terms of the older generations and helping out the younger generations entering the property market? Because that's been one of the biggest supports for prices, and I'd love to know what you're seeing.
Yeah, look, we're seeing lots of it. And, we have some high net worths here, and the amounts you're talking about, we're talking millions to gifted. The first thing, I'll actually flip this slightly. The first piece of advice goes to the people giving the money. Get it secured. So basically what we recommend to clients is you're giving to your son or daughter and their spouse to buy their, forever home, to use the word. Take out a loan against that, giving that money in. So what it does is you don't get any interest. You can forgive the loan later, but it protects you from a separation. You need to protect your money, because it is your money you're giving away. So at the end of the day, you gave $1 million, and we'll say someone was really generous, gave $1 million. They bought $1 million house. The house is now worth $2 million, and the couple decide to split. Okay. Now they're going, okay, well, that's $1 million each. And the parents are going, hold on, I put $1 million into this. So it gives you the ability to pull your $1 million back first before assets are split. So I think from a family protection point of view, that's really, really important. Some people will be really uncomfortable with that conversation, but probably worth having. But yeah, on the other side, on the positive side, we are seeing money coming in. We're allowing people to go and get into homes that they would not otherwise be able to access.
Yeah.
And I think, there is superannuation law changes, a bunch of things there. I think it's demographics.
Okay. Yeah.
There is just getting to a certain point in our society where there is a large amount of older, wealthy, to use the term, boomers. And they are getting to a point where their kids need support because the property prices have gone up so much and wages haven't been in line with that. So the proverbial bank of mum and dad is probably got more cash than ever. The other thing is people have got interest rates that are super high now. The people who have money through this period of interest rate rises are making more money than ever.
Yeah.
So there's more to go around.
That's a really good second point. I hadn't thought too much. There's been a recent boom in prices as well. Stock markets are holding up, and that's so their wealth positions increased a lot in the last couple of years as well. So they feel very comfortable, way more comfortable than they have in the past. And then you're right, they're getting a decent return on their cash, and they're almost like printing money. And they've got their kids who have now potentially got their grandkids coming into the world, and they're like, well, we can't get a house. We're gonna have to leave Sydney.
Yeah,
their only options. They want to see the grandkids. They've got to keep their kids in Sydney, and I think that's what we're seeing. And it's astronomical, to be honest. I think it's just one of those tectonic plates. Because when you look at the boomers, this is really just the start of it. The property market's worth roughly 10 trillion. There's 2 trillion of debt. There's so much equity that is getting passed down and multiplied. And I hadn't really seen it, to be honest, till the last 12, 18 months. Obviously, it was occasional, but it's pretty big. A bit of a longer episode than normal, but there was so much I wanted to chat to you about, George. So thanks so much for coming on. I really appreciate it. If people want to hear more about you, is it pp.tax? Is that the best place?
One. Yeah.
It's a very good little website. That nice and easy to talk about. And thanks everyone for tuning in. If you want to know more about our business, mortgage broking, obviously there's a link in the show notes. You're more than welcome. And all the resources for other crew on the podcast. And thanks for tuning in. And we'll see you all next time.
Thanks for having me, Chris.